Okay, welcome everyone to, we were talking about regulation a little bit earlier at the keynote, and we actually have the regulators here, so we can hear it directly from the horse's mouth. And I got to admit, why is regulation important? And I flew in last night from Toronto, and one of those things where I'm glad there are safety standards, when the planes can go, if the maintenance is done correctly, and that. The technology of flying only gets you so far before you can get the economics, because you've got to get the regulation right before society starts to use and trust it. We're in this brand new building, and once again, I am so glad that the civil engineers tested the concrete so that we actually are here safe and can utilise these sorts of, we're in New York, we have towers everywhere. We don't want to have something just fall apart us and lose the trust of society. So what these guys do that we're going to hear is so vitally important for us to even have a chance for this technology to make a difference in our lives. So Augustin, would you like to introduce who we're going to panel?
Thank you, Bruce, and also let me introduce Bruce. Bruce is also the managing director at the Global Risk Institute in Toronto, which is one of the main organizations in terms of risk management in Canada. And dealing with all kinds of issues, including financial technology. And I'm Agostino Gapponi, one of the conference co-chairs, together with CIAMAC, and I'm also the director of the Columbia Center for Digital Finance and Technologies here at Columbia. And without further say, I would like to start introducing the four panelists who really will have a lot to say about regulations. And I want to start with Valerie Stepanek. I hope I pronounce it right. Okay. Yeah. And she is the head of the Strategic Hub for Innovation and Financial Technology at the SEC. And she's also the Senior Advisor for Digital Assets and Innovation and an Associate Director in the SEC's Division of Corporate Finance. Go ahead, Valerie.
Oh, go ahead?
Yeah.
Okay. Hi, everyone. Good afternoon. It's really great to be here. Before I start, I just have to say that I'm talking to you in my official capacity, but my views are really my own and may not represent those of the commission or any of the particular commissioners or anyone else I work with. With that said, it's really a pleasure to get to talk to you. Clearly, all of you are very steeped in the important and challenging topics that we're here to talk about today. And I could tell from some of the other questions from some of the other panels that you probably have a lot of questions for us. So I'm going to try to be brief as we introduce topics and set the stage, and then let you guys ask questions of us. So just, to set the stage, in the US, there is kind of a framework of regulatory obligations that apply to the provision of financial services and products. And there's not only a federal framework, as you know, but there's also statewide regulations and regimes. And so the one challenge that I think that digital assets or crypto assets has presented is the fact that, I'll say this, and maybe it's controversial, but I don't think crypto assets are an asset class. I think a crypto asset can represent many different things. And so it's a representation on chain of something that exists, something of value, and that something of value could be a security, it could be a commodity, it could be insurance, it could be something else, a piece of art. But that's what makes it complicated, because sometimes, these regulatory schemes that we have are set up to not only regulate marketplaces to make sure that things are traded in a way that's fair and transparent and available to everyone who's using the marketplace, but there's also a layer of regulation that applies to what is being traded. And so the regulations that apply to airplanes or cars or used car parts are not the same as those that apply to securities or derivatives or things that are much more complicated and may present risks to people who are buying and selling them. So with that said, we do have a pretty complex regulatory structure in the US. And so I'll just start with the SEC. And the way the SEC looks at things is really, we're going to look at all the characteristics of a crypto asset, including all the facts and circumstances about how it's being issued, how it's being traded, how it's being marketed, the manner that it's being used, and we're going to determine, based on those facts and circumstances, whether it falls into one of our definitions of security. And the definitions of the security is, they appear in the Securities Act, so there's the 33 Act, the 34 Act, the 40 Acts. 33 Act really applies to the issuance the initial offer and sale of securities. The 34 Act applies to the secondary trading and the intermediaries, and the 40 Acts apply to investment companies and investment management. But there are several definitions: stock, transferable share, debt. These things are all securities and they're regulated in a certain way. But there's also this kind of broad-based thing called an investment contract. An investment contract is really meant to catch the things that are the essence of a security. So if people are investing something of value into a common enterprise with a reasonable expectation that somebody else is going to undertake managerial and entrepreneurial efforts to give that investment value, whether it's through a secondary market trading value where it goes up, or it's some kind of payment of dividends or some income stream that's derived from the instrument, then that thing is a security under the federal securities laws of the US, under the investment contract test, which is also called the Howey test. And it's funny because before crypto assets, I had worked at the SEC a long time, and I'm not sure I ever really thought too much about the Howey test, because many things clearly that we regulated fell within, a stock or debt or something like that. But now I can talk to folks on the street who probably have no securities background, and they have heard of the Howey test, and they can probably recite it back to me if they've done any kind of research in the area of crypto. So that is our gating question. Does something fall within the definition of a security? And if it does, then all the securities laws apply, and these securities laws really apply to protect investors in the markets and to promote capital formation. Those are the kind of key mission statements of the agency and the federal securities laws. So with that said, we recognized early on, and I've been working in this space since about 2012, so I'm an OG in crypto terms. And in this space, at first we were really doing a lot of research to come up to speed. There are a couple of cases out there that we were looking at involving Ponzi schemes, for example, that used Bitcoin instead of cash as the denominated asset that they were collecting from investors, but not too much until the ICO kind of events happened. And so we began looking at this thing called the DAO, the Decentralized Autonomous Organization, that became kind of the subject of our report of investigation that we issued in 2017 at this time, which kind of explained to the community how we do apply the securities laws to an ICO, or an issuance and distribution of tokens. And in that case, determined that was an offer and sale of securities, and kind of made the statement that all these laws then apply. So secondary trading platforms should keep this in mind. They may need to come and register with the commission if they're trading securities, and people like investment advisors who give advice around these things should also keep in mind that they have registration requirements as well. We also determined around that time, that it would be beneficial for the agency to create my office, which is the Strategic Hub for Innovation Financial Technology, where a lot of what I do is to try to interface with developers and entrepreneurs who are out there in the public trying to innovate, and inviting them to come in to talk to the staff, to try to get them to talk to us about what their projects are, and how we talk to them about how we look at the laws. And we can't give legal advice because that's our client is the commission and not the people who come talk to us. So that's kind of a conflict. But when they do come and talk to us, I think we do have a very beneficial exchange of information. We can often tell people, look, you may be bumping up against the laws in this respect. You might want to think about this a little bit. You might want to get some advice in this aspect of your project. And oftentimes they go away, and then they do, innovate in different ways. And I would say that I think I'm probably running out of time, but I want to just frame this with the message of this public-private engagement is really critical in this space. What I don't want to see is a polarization that happens all too much in other aspects of our society in general. But if there's a polarization here with this type of innovation and disruptive technology, then we really come to a standstill, because regulators, because the people who are innovating don't hear what the regulators have to say, and there are legitimate policy frameworks that apply, and we don't hear what the innovators have to say, so we don't know what the pain points are or what they're trying to do or what they're trying to accomplish. So unless we have this public-private engagement, and this is really part of it, I think we all suffer. So I just want to end with a note of encouraging people to talk to folks like me at the SEC, but also across the federal financial regulatory system. There are innovation offices, I think, in every single federal regulator that I know. So there are people out there who have the same exact function as I do. And so the doors really are open. And I know there's a lot of press out there about that the door isn't open, but I have never turned down a meeting with anyone who wants to talk to us. We have a staff of people who are happy to talk to folks. And, I literally have hundreds of meetings a year. So I just want to put that out there and turn it to the next guest.
Yeah, thank you, Erin.
You're opening the floodgates there.
And there will be a lot of follow-up discussion, so whatever you have not said, you can say afterwards. So let's move on to Mohammed Al-Bastami. So moving from one jurisdiction to another. Mohammed is Managing Director of Technology Risk Division in the risk support sector within the Office of Superintendent of Financial Institutions in Canada. And he leads a team which is focused on reviewing technologies, crisis reporting, networks, and digital technology.
Thank you. I'm just going to be reading some remarks that I prepared for this. Thank you, Agostino, so much for having me. Good afternoon, everyone. Happy Friday, and happy Cinco de Mayo as well for anyone who's celebrating. As mentioned by Agostino, my name is Mohammed Al-Bastami, or Mo, and I am the Managing Director of the Digital Innovation and Impact Hub at OSFI. Thanks for having me today. I'll be speaking about the broader digital innovation happening within the financial sector in Canada, including crypto assets, stablecoin, DeFi, etc., their associated risks, and most importantly, what OSFI is doing in terms of planned response. And it's interesting because there's a lot of synergies of what Valerie said, and it made me smile. But quickly, just kind of to introduce, because this team is relatively new as it relates to OSFI, the Digital Innovation Impact Hub. We're just about a year old in this space. And I'll talk a little bit about our direction, what are we doing, some of the work we've done, maybe a bit of teasers for some of the work that's about to come, or also encouragement about that public-private conversation. But before that, maybe for the audience, just because I'm coming from Canada, maybe a bit background on OSFI. So again, we're the Office of the Superintendent for Financial Institutions, and we are the federal prudential regulator in Canada. Our focus is the safety and soundness of the financial sector in Canada. OSFI regulates and supervises more than 400 federally regulated financial institutions and over 1,200 pension plans to determine whether they're in a sound financial condition and meeting their requirements. OSFI, though, have been going through its own transformation the past about 12 to 18 months. We published our blueprint about, I want to say now, 18 months ago. We also published our strategic plan, and more recently, about 2 weeks ago, we published what we call our annual risk outlook, and this was our second time. So the first one was last year, and this is the second time around. And I would encourage everyone to kind of check it out. Again, it's public. It kind of highlights the risk areas of focus for OSFI, and what are we doing about it, both from a policy perspective and from supervisory perspective. But that kind of transformation basically created the perfect runway for the hub to be created. And ultimately, this team is responsible for crafting and preparing OSFI's response as it relates to these digital innovations from a policy perspective, supervisory perspective, and how our institutions should handle these risks appropriately. So if we want to zoom in a little bit, this team is kind of considered with 4 pillars, and you'll get a sense of where I'm going with this. There's a policy pillar, a supervisory pillar, a stakeholder engagement pillar, and OSFI's digital innovation sandbox. And all of this will kind of touch as well what Valerie was talking earlier about. The policy pillar is something, part of the team that basically is going to look at our suites of policies and say, are they fit for purpose for all of this digital innovation that's happening? How should we, what kind of policy instrument do we need to develop to supervise stablecoin issuers or any stablecoin activity or crypto custody or DeFi in the future once it's more broadly adopted within the financial space or other digital innovation for that matter. This is the part of the team also that engages internationally in all of these international sitting bodies, the FSB, the BCBS discussions, to ensure whatever we're going to develop is aligned and consistent with those international sitting bodies. But also we talk and discuss a lot with our partners provincially. So again, that's kind of started to kind of paint a little picture about the ecosystem in Canada. We have federal regulator, we have provincial regulator, we have our Department of Finance, which again, all of the work we're going to be doing is going to align to some of their work. They're actually right now going through a legislative review of digitization of money, which is going to be essential to kind of looking at all of this innovation and how it will be regulated and overseen. In terms of the supervisory pillar, which is kind of the second, like the other part of that coin or the other side of that coin, that's part of the team that's going to actually go into our institutions and make sure they are managing the risk associated with these innovation appropriately. That's the team, part of the team that's going to equip our first line supervisors to understand these innovation and arm them with the knowledge and the tools to determine the risk associated with this. And again, the topics are very actually broad, from crypto and stablecoin to advanced AI to open banking or open finance, and of course in the future quantum computing potentially. The stakeholder engagement to me is a key success to a lot of the work we're doing, and it's usually an underseller. We usually, as the regulators, are looked at as closed door. We just talk to our close partners or other regulators. But in my opinion, in this space, in the digital era, like we have to work with industry partner, with academia, with research center. We actually have an opportunity here, in my personal opinion, that we're relatively still early. So yeah, we're playing catch up, but we are still early, and we can probably capitalize on this and be able to create something that can be used and support innovation in a safe way. And on that note, we actually yesterday initiated what we call the Open Door, OSFI's Open Door Initiative. And basically it's an open door call to anyone from fintech, startups, academia, research center, and in between to come and talk to us about any topic, and hopefully it will inform our supervisory work and our regulatory work as well. So again, if you haven't checked it, please take the time and check it, and we'll love to hear from you. Finally, the team, as I mentioned, is very, very early stages in building and thinking about OSFI's Digital Innovation Sandbox. This is something that we want to kind of take our time in thinking, but we think as well it will be of huge benefit, and we're kind of excited about it. We want to be able to provide a safe space for financial entities and beyond to show us their innovation based on a defined set of parameters that will be built in the near future. Basically, providing them a safe space that they can come bring their innovation will enable us to learn and hopefully be able to respond in a more agile, if I dare use that word, way to some of these innovation and provide them the safe space to innovate as well. Finally, probably just a teaser of some of the work that we're doing with our actual institutions. So is something we've done in the past year. We actually reached out to our institutions and did a quick crypto survey to understand what is, how far is this within our supervised institution. So we sent the survey to our institutions around May of last year. Basically consisted of 3 items. Current or planned activity as it relates to crypto assets, discussions with senior management or your internal board as it relates to crypto assets, and if you have any plans in relation to DLT technology and application, and any risk assessment that you have done in relation to these activities. And we received the responses around the summer. We went through it and we created a high-level internal report, but I can share a couple of highlights just for the benefit of folks here. So in total, we actually got 16 responses that qualified of institutions having crypto-related activities. A further 2 responses were not classified as having crypto-related activities, but just assessing whether to engage. Out of these 16 responses, 13 banking institutions and only 3 insurers indicated crypto-related activities. I should mention that part of this response, or we did count any response that were part of a foreign branch that's operating in Canada, even if the activity was outside of Canada, since the parent company did disclose to us, so we count it as an activity. In general, we found that systemically important banks are more inclined to capital market crypto-related activity, while small and medium-sized banks were more interested in custodial type activity. We have not found any common thread among insurers. If we double-click on our systemically important bank or deposit-taking sector, most of the activities were in the capital market making and retail trading. Some highlighted crypto ETFs and market-making activities, and other have activities in trading crypto-linked securities. In contrast, there was only one response provided information on their planned activity for stablecoin type or stablecoin-like arrangement in terms of providing these services. And as I mentioned, a couple were interested in custody or crypto custody type service. A couple of interesting POCs as part of that also was really in relation to using DLT technology for identity verification and for key encryption distribution. So these are one interesting things that we wanted to explore more with our institutions. So we'll be having discussion with them to understand that a bit more. I'll close by saying, again, we are, in the next 12 to 18 months, we're going to be working a lot in this space. We actually have a consultation letter right now focused on the fiat reference crypto assets, most commonly known as a stablecoin, or one of the most dominant form of stablecoin, in order for us to start thinking about the risk management expectation as it relates to this. How would we supervise our institution that would want to issue or play in that space, and the work that needs to be done. I'm definitely over time, probably, so sorry for that, and I'll stop here.
Well, thank you, Mohamed. Now going back to the US from Canada, let's hear from Francesca Carapella. Francesca is a principal economist at the Federal Reserve Board of Governors, and she's in the Payment System Studies section. And she is also an adjunct professor of financial regulation at Georgetown University. And she has done a lot of interesting work on financial stability in the context of digital assets. And she has published in highly regarded journals such as Journal of Financial Economics and Review of Economic Studies.
Thank you very much. Thank you for inviting me to this super interesting and stimulating conference. The first thing I need to say is that anything I will say are my own views and do not represent those of the Federal Reserve, and nothing I will ever respond to your questions reflects anything that the Federal Reserve views. They're my own personal views. And let me start by, saying that as soon as I read the title of the panel and I read the digital finance, the first thing that came to mind was, what do I think about digital finance? What is it? And the way that I think about digital finance is really like by partitioning it in 3 sets. First, innovations in traditional finance, and some of those examples that you all have brought up today, this morning, could be, for example, JP Morgan Chase blockchain Onyx and its coin tokenization initiatives, and even back in time, futures on crypto assets such as Bitcoin that are cleared at traditional financial market infrastructures such as CME. The second set is the set of essentially centralized finance on blockchain. And so we think about lending and asset management activities that are offered through basically standard centralized exchanges just on blockchain, such as Coinbase, Binance, used to be FTX. But also some of these elements are in the way that we think about, at least I think about, reserves of stablecoin issuers. Those are essentially somewhat standard assets as well, most of the time, in some cases. And the third set is the decentralized finance, where again we see lending, asset management, margin trading, in some cases with infinite leverage, such as flash loans, that are offered through decentralized exchanges, such as Uniswap and Curve or DYDX, and more to come. And they operate in a very different way from the standard centralized exchanges, because they operate mostly via this concept of liquidity pool, which is pretty new to centralized, traditional financial institutions. So then this is a panel of regulation, and the way I think about the need for regulation comes from economic theory. And economic theory teaches us that regulation is needed only if the equilibrium is inefficient. So in other words, in this case, only if digital financial markets had some failures one way or another. So do digital financial products generate externalities? Do they create interconnections that themselves can generate externalities? In practice, even if the theory tells us that there is a role for regulation anytime there is an inefficiency, in practice, there is a role for regulation when such inefficiencies are sufficiently large and triggers concerns for either financial stability or consumer protection. And the reason why I say that they have to be somewhat sufficiently large is that typically we tend not to intervene by distorting markets if the inefficiency seems to be relatively small. So we're concerned about issues such as financial stability, that is of large concern, or consumer protection. And I'll focus more on financial stability because that's where my work is mostly focused. And so I'll go back and map these concerns to the partition that I described at the beginning. So when it comes to innovation in traditional finance, some of the obvious concerns for financial stability on digital finance come through, for example, tokenization, and mostly via the redemption option. Because that redemption option, as it was brought up during the previous panel, via essentially an arbitrage activities, link the market for tokenized assets to the market for the underlying real-world assets. So think, for example, of a fire sale on the asset for tokenized markets. Then I might have an incentive to go and buy that cheap tokenized asset, redeem it for the real-world asset, and then go and sell the real-world asset and cash the proceeds. So fire sales on the market for tokenized assets can be transmitted on the market for the underlying real-world assets. So there is a link, essentially. And this is one concern, but going back to some of the examples I brought up from the beginning, obviously, some of the obvious concerns are also the link through traditional CCPs or how and when JP Morgan Chase will use its coin or its blockchain. When it comes to centralized finance, a possible concern can be runs on stablecoins that can cause contagion to traditional financial markets, for example, via fire sales of commercial paper markets, which we had freaked out about when we saw, sorry, that's not a good word to use, but yeah, we panicked about when we kind of saw slight depegs for Tether, for example, when we didn't know exactly back when Tether collapsed and Tether kind of depegged, nobody, I guess, really knew what Tether was holding. And so part of our concern was what's going to happen to the commercial paper market? Shall we panic? Shall we do something? And another proposal that's on the news is, for example, the reserve funds that Circle has proposed to open up at BlackRock, and it's possible access to the overnight reverse repo facility at the Fed. Shall we think about that, for example, as something similar to a central bank digital currency? And if so, then all of the stuff that we have been studying about CBDC and its impact on financial stability might come up for this reserve fund. So there are, obviously these are just examples, but that's how I think about financial stability in this setting. And then the last one for DeFi, there are possible concerns that we're still trying to understand, or at least I am still trying to understand, and that comes from the possibility of DeFi to generate interconnectedness between blockchain financial markets and traditional financial markets, engaging in maturity and liquidity transformation, which is an activity that we are very careful about when we think about financial stability. and margin lending, which is also an activity that we typically regulate, and that is less so in digital finance or in DeFi especially. I'm going to stop here. I'm going to give the floor to Michael, who is going to go a lot in more details.
Yeah, thank you, Francesca. Let's move on to Michael Lee from the New York Fed. And Michael is a financial research economist in the Money and Payment Studies section. And he's also in the Financial Stability Policy Research Division. And he's also published academically, I guess, papers in the Journal of Financial Economics and other good journals. Go ahead.
Well, thank you for having me here. Same disclaimer, the views expressed here are mine and not necessarily that of the New York Fed or the Federal Reserve System. So I'll start with the very obvious observation. Finance is one of those sectors where with the advent of technology, it co-evolves. And we've seen that for a very long time with the way in which we can share, disseminate, and aggregate information. We've seen different information structures. We've seen increases in speed and the availability of markets. And now we're also considering different changes in terms of how we trade and settle. So I think when we start to think about digital finance, we need to have an all-encompassing view. It can relate to innovations in traditional finance. And Francesca mentioned some things like tokenization or overall changes in the financial architecture that we have today. It can be about centralized finance or decentralized crypto intermediation and how innovation's there. And it can also be about decentralized finance in the sense that there are decentralized organizations and exchange and different types of commerce. So today I'd like to kind of pinpoint some specific things, first starting with core issues. And as kind of it's already been discussed widely, there's two things that you can think about that kind of gather a bulk of the regulatory concerns or considerations you might have: financial stability and consumer protection. Second, I want to highlight some novel issues that we're seeing that may relate to these issues, but are particularly important as we look to the future. And in the background, I want to note that it's really important for us to always think about the nature of innovation that we're talking about. Is this innovation to do with regulatory arbitrage, or does it represent some type of fundamental innovation that we need to truly unlock the potential of? So rather than kind of go through all of the issues, I want to use an example. So today we're in a current stage where we're trying to match or best match the regulatory framework to the type of activities that we're seeing today. And this has put us in a position where we need to think about whether something is something or not. Now, is it a bank? Is it a money market fund? I don't think I need to explain to you what I'm talking about. We can call it a whole new thing, but economics tells us that what we really should care about is the function. What is the economic function that this entity or activity is providing? And what are the appropriate regulation that we should match it with? So we have a long history of academic and policy work thinking about financial intermediation. And there are various different aspects that we care about. It could involve liquidity transformation. There could be opacity. And there's some form of delegation in the process. And we have a good understanding of how this can lead to financial fragility, for example, in the form of runs. Now, with runs, we also need to then think about externalities. How is it connected to other things? Is there potential for fire sales? What are the other contagion aspects that we should be keeping in mind? So, in a broad stroke, what does this tell us? Well, the optimal regulation is about matching the types of necessary regulation to prevent and manage risks, for example, with respect to financial stability. And we already have a lot of history and experience with developing over time what type of tools are necessary to do this. Now, I think it's still important to take a step back and still have a very comprehensive view, though, because we need to have a better understanding of the mapping and measuring of the channels and the mechanisms of financial fragility and its amplification and propagation in terms of these novel arrangements and entities. And I think there's a lot of more work that we need to do to understand the nuances and subtleties that arise in these different types of arrangements. And of course, I think in this respect, though, the same principle applies in the context of consumer protection. But I'd like to speak a little bit more on this, coming back to the question of innovation. So what is the core driver of new markets, these entities and arrangements? I think this is a question that we need to ask ourselves when we're seeing the emergence and development of these things. And I think this boils down to some question about control versus innovation. So it could be that a potential reason is because in the legacy environment, there is inequitable or restrictive access to certain types of investment opportunities that consumers or investors wanted that were hard to get due to various restrictions that they have, for example, in the guidance of consumer protection. So this is a legitimate reason to think about what is being overcome through these new markets. Another question is whether this is due to inefficiencies and unmet demand for certain types of transactions. You might think that cross-border transactions are really inefficient, and because of this, having a tool that allows you to do that better than what you have in the legacy system might be very attractive, setting aside how you achieve it. But this also has to come with the question of what the nature of innovation is. So, is this innovation really fundamental? If you think about trustless transactions, that's a true fundamental innovation because it's really challenging to do in the legacy environment. Or is this innovation a form of regulatory arbitrage? So if you think about the money market funds in the 80s, there were limits on what the interest can be paid on deposits. And money market funds was a device for investors to get higher yields and overcome this regulatory restriction that banks could not participate in. But I'd like to think about a way in which there can be complements between. And in particular, I think an impending question is, are there technologically enabled solutions to improve on our current tools and frameworks? But presumably, all of the regulation that we have on today and that we've developed are there for good reason. And the hope is that there can be ways in which technology can enable us to improve upon the current, perhaps blunt implementation of regulation. And this would indicate and be an example of a clear form of fundamental innovation. Okay, so I'd like to then now touch upon some rising issues, and I'm going to highlight two kind of aspects that I think would be worth for more people to think about as we look to the future. And the first is on the issue of privacy. So we have throughout today had questions and comments on privacy, and it's really clear that there is a rising challenge for privacy overall. First of all, there's a digital footprint for virtually all of the transactions that we participate and partake in today. And it's really challenging for us to actually do anything about that. And in general, there are severe limitations for us to preserve privacy or, in a more institutional case, prevent information leakage. In certain instances where this had become a significant issue, markets have developed certain mechanisms in order to conceal this type of information leakage. This is how critical this is in certain types of activities. And so we're seeing innovations to tackle and insulate this, users from the leakage of information or privacy today. So this can pose a real innovation in terms of how we think about the way in which transactions are processed and sealed from public purview. That's different from the legacy environment. And this will also relate to an important feature of censorship resistance, we'll come back to in a second. Now, on the flip side, a lot of innovation has also led to the enhanced ability to monetize on malicious activity. So we know for a fact that there is greater circumvention of economic and financial sanctions today. And this is facilitated by decentralized finance, for example. And there are better ways to monetize on security vulnerabilities. One example is directly taking advantage of protocols and exploiting weaknesses. And the second thing is actually using cryptocurrencies in order to use as payment for ransomware. And this enabling of being able to monetize it enact payments outside of the regulatory perimeter has also allowed for ransomware to be a much more profitable business. So we live in the crossroads here, where we see this rising need for privacy, but these privacy tools have also enhanced the ability for us to, or weakened our ability to curtail this type of activity that we don't want. And so there's a broader question here about the optimal provision and governance of privacy in financial systems that I think we will need to face both academically and in terms of policy. This can be in the form of private platforms. It can be in the form of public initiatives. It's something that we're going to have to confront and make some decisions on looking forward. The second point I want to talk about is on the question of regulating decentralized systems. So how can decentralized systems be effectively regulated? And here I'm talking about true decentralized systems. Well, there's some questions in terms of it because it poses considerable challenges. It has decentralized governance. It's hard to attribute and sometimes hard to control. And even if you were able to achieve certain things like this, the operations can be easily replicated and duplicated for future use. And in some ways, this is also the duality of some fundamental innovation that we've seen. The culmination of these features is also what gives it censorship resistance, which is something novel and something potentially valuable for society. But it also poses significant challenges in terms of regulation. If we think about the OFAC sanctions on Tornado Cash, initially we saw that they were able to halt a lot of payment transactions being settled that involved Tornado Cash. Now, over the last few months, we've seen that over time, this has been, the effectiveness of these sanctions have diminished. Instead of being able to completely restrict the settlement of Tornado Cash, we are seeing that it's merely slowed down the processing of these types of payments. And so this indicates that there needs to be more innovation and more thoughtful approach to also regulating DeFi that we're going to face increasingly as an important issue going forward.
Thank you, Michael.
So Michael, I think we'll have to touch on those 2 points that you raised in a sec. But what's going to happen is that Augustine and I will have a couple of warm-up questions first and then open it up to the floor. But I think my first question, I might actually go to my countryman Mo first up, and then feel for the others to feel free to jump in afterwards. But yeah, so Mo, how should policymakers and regulators think about striking that balance between promoting innovation in digital finance and ensuring financial stability? And I guess I'm picking on you particularly because Canada's had this trouble of when we sometimes get a little bit heavy-handed, we get the brain drain that just goes south of the border. And that's one thing that we also need to protect.
Yeah, thanks for this. And it's a very interesting question. And it's going to be all about, you use that word balance, right? Like we have to balance things out. We have to focus from a prudential perspective. We have to focus on the safety and soundness always. That's going to be always top of our mind, right? To ensure that the stability of the ecosystem continues to operate in a safe and sound manner. So that's always going to be our guiding principle. Having said that, we also welcome these innovations because we understand that that's the future. Right? This technology is here. It's going to help us move forward, and it's going to allow hopefully more competition, more fairness, et cetera, et cetera. But it has to work nicely between balancing that kind of fast innovation, but also understanding what it means from a regulatory perspective. And sometimes I look at it from the fact that a lot of the stuff starts with fundamental risk management. You need to start thinking about that. You need to start thinking about, maybe history books. Look at a little bit of a history books. A lot of these problems that happened, let's say in the recent few months, whether it's FTX, Celsius, et cetera, a lot of it is fundamental risk management practices, governance, fraud, oversight. So, these things have to start coming into the minds of those innovators as they innovate and understand. And again, engage, right? Like come talk to the regulators to start understanding where is a good starting point? You know, start thinking about compliance, at least as a mindset. I think that will probably help us to kind of continue that dialogue of having innovation and fostering it, but also hopefully help the innovators to start getting a sense of where to start. Because I think sometimes it's a challenge for them to say, like, where should we start? Well, there is a place you can start from, and that is definitely engagement, but also looking at some fundamental risk management practices.
Yeah, but one of the aspects, as in digital finance, we are talking about something could easily spread around globally. Is regulatory arbitrage something that you guys are considering? Yeah. SEC.
Yeah, sure. And I think one of the questions posed by Michael in his presentation was interesting because, from our perspective, I think as regulators, it seems like a lot of projects are trying to design themselves in a way where they're not subject to regulation, but at the same time providing traditional financial services that are heavily regulated for very good reason, because you're managing and holding and trading other people's assets. And so there's a bit of a tension there. I hope that people are not doing things to intentionally evade regulation, but I want to back up a little. I think, back to your original question, I think it's essential to have trust, and trust on both sides. So trust that the regulator will engage with you and be honest with you, and that developers will come in and be honest too. So I think there's a lot of very hyperbolic talk and labeling in certain new technologies, and I think it's certain people want to tap into the exuberance of a new technology, and it brings in VC money, it brings in investors, whatever. But I think it's important for people who want to responsibly innovate to be very honest about the limitations of the technology, where you are along the innovative arc, where you're going toward, where you really see the solution, and then talking to the regulator about, all right, what are we trying to solve for here? Why are we using this technology? What are the risks that we're dealing with? And then when you think about how typically technology is developed, in many aspects, there's going to be tests done, there's going to be redundant systems, there's going to be a step-wide approach to going from A to B. And what regulators see very often, and it's because this is developed in an open source environment and it's global, is that a lot of experimentation is actually happening in real life with real people's assets at risk. And so regulators tend to get worried when they see retail exposed at very large amounts in an atmosphere where we don't see full disclosure, we don't see a full understanding by the retail about what they're getting involved in, and we see a lot of risk and actual harm that's happened over the past year. And so I think just building the trust between the conversation that needs to happen and then just being honest on both sides about where we are in our process.
Bruce, can I actually follow up? I thought I wanted to continue the conversation a little bit more, highlighting the difficulty between, striking this balance between regulation and innovation. And my personal view is that so it is a very difficult job. And my personal view is that a successful way to do that must involve, to a certain extent, some skin in the game for the entity that is regulated. So and the reason why I say that is that as we heard today over lunch, and it's been apparent in the monetary and banking history, anytime there is a regulation, I'm Italian, give me a law, I'll try to figure out a way to get around that law. And that's how regulation is going to play out. You're going to try to find ways to get around that and to play regulatory arbitrage. So one way in which I personally think it might be an effective way to move forward is to engage the regulated entities with skin in the game. And I can give a concrete example of the history, I guess, of the United States, but that I think might have been one of the bullets that Michael popped up. So this was, I guess, when banking crisis, where banking panics were extremely frequent, banks would pull together their balance sheets and they would start honoring the obligations of each other in that clearinghouse without releasing any information about the balance sheet of any individual bank apart from the banks as a whole, as a member. So there was an effort at that time where there was no FDIC, no backstop, implicit or explicit by the government. There was an effort from the industry of putting their mechanism to solve that problem. And so in the same way as they put their skin in the game, I think an effective way to conduct regulation is find a way to have them put skin in the game. So if, again, personal view, but any type of explicit or implicit guarantee or a blanket deposit insurance can fix a problem. You might fix a problem in the short term, but might generate longer term issues with respect to moral hazard and might just continue to feed in this type of events that keep happening. So unless we find a way to get skin in the game, I don't think we're going to have to solve the problem. This balance is not going to be, we're not going to strike a balance between these two forces, I don't think.
Speaking about skin in the game, what's the regulator's skin in the game? Is that fair to ask?
I can tell you, I am a regulator economist, and so I will tell you what I put up as the first bullet on my second slide. That is what economic theory teaches us. And so the way I personally think about any problem that is put on my desk is what would a social planner do? How do I write this problem in terms of a Pareto efficient allocation? I want to know what's the first best, then what's the equilibrium, what are possible inefficiencies or frictions that prevent the equilibrium from being efficient, and then how do I fix that? So that is how I personally approach anything.
That's an intellectual exercise. The question is the institution. What does it pay for screwing up regulation, for over-regulating, under-regulating? In the end, when you go back to the regulator and say, you screwed up, you got to get punished for that.
Yeah, that's accountability, right? That's accountability. That's how you got the Vice Chair Barr, I mean, just giving an example, Vice Chair Barr demanding a examination of what caused San Francisco Fed messing up with SVB. I think that's accountability. Then, I don't know, are you going to fire?
The reputation and the history. You don't want to trail a failed trail.
But nobody got fired, right?
So what I was going to say is that obviously I don't know who's going to get fired or not. I don't know if whoever implemented those lack of a attention is going to not get a bonus or is just going to have more eyes on his or her shoulders when they're going to be doing the next supervision. So it might be that every time that person writes a report, is going to have to be going up a chain of controls. I have no idea, but there is some public accountability. At least there is public accountability, and you're able to see what some investigation found out about what went wrong in that case, and then you might propose whatever. We're public. We work for the government, so you might come up and propose whatever you want in terms of giving the right incentives to the San Francisco Fed to do a proper supervision and regulation. That's accountability. Information is out there. That's accountability. We're government officials.
Moving, just want to ask a question, then let's open it to the floor. So I mean, in terms of the financial stability implications, I have a couple of questions for all of you. So the first one is more about I think probably mostly for Francesca, about the link between real-world assets and tokenized assets. And then you mentioned that there might be spillover effect from the tokenized market to the real market. I'm wondering whether here you are thinking mostly of stable coins, where the linkage between tokens and real-world asset is more prominent. And I'm also wondering whether you think that this could be a substantial channel for financial instability, but considering that most of the events that we have seen so far have mostly been confined within the crypto market, if I think about FTX, Terra, and all the other events. Or you are thinking like more broader linkage that we could see between crypto and real world markets. Let me ask also the second question, which is a little bit related to the question, to the point about customer protection, if you want to enforce some regulation on the digital finance or on the blockchain infrastructure in general, everything is public access, so there are no concerns about privacy. You could always identify the digital address which is responsible for some bad activities, and we see a lot of bad activities, like we see front running, which came up also in some of the previous discussion, but we cannot do anything because we don't know who is liable and we don't know how to bring them to court. So I'm wondering whether there is anything that one can do in order to regulate these activities which which should be considered to be legal and not allowed.
So let me touch on the tokenization. I actually was thinking more broadly. So stablecoins is one example, but I was thinking more broadly, and so it goes back to Nathan's initiative of, for example, tokenizing treasuries or any other asset. I think the example that I was giving is, I guess it's broader than stablecoins, especially because there are so many real-world assets being tokenized that I find it extremely fascinating, and I find the benefits of tokenization also extremely fascinating. Let me point that out straight away. I only highlighted the possible financial stability concern through fire sale, but I think it's extremely fascinating. But we do need, I think, we do need to keep our eyes open and understand the mechanics behind tokenizing off-chain assets, tokenizing grain. I learned about those initiatives too, and those tokens, tokenized grain, being used as collateral for loans. So there is, it's not just stable coins. There is a lot going on that links, I guess, digital finance and crypto technologies to real economy, and it doesn't get more real than grain, right? When you think about that. Coming to, I guess you were mentioning about the second point on regulating those activities. Yes, absolutely. One that comes to mind is, I think one of the first things I ever read was the DAO white paper, and effectively how it was allowing for margin lending and effectively taking more price exposure to a certain asset by just building. Put an Ether, get a DAI, put more Ether, get more DAI, put more Ether, and you get more exposure to whatever asset you deposit in. So yes, absolutely, we need to understand. What I'm learning is that we need to understand the mechanics of some of these initiatives, because some of these activities, such as margin lending, might be, let's say, hidden in the protocol, and you need to understand that. To the extent that it is observable, that you might be able to regulate it. When it's not, that gets into the point that Michael was bringing up, and that's a real challenge. I know that there are initiatives in the private sector. I know a company called, I think, Chainalysis. Yeah, that's putting some efforts into, I guess, bringing up to light what's under the table. But that's a difficult problem.
Listen. Yeah. When you talk about the SEC, the SEC, I'm sorry, it's a government regulator, but it's also a government institution appointed by the president. It's a political institution, even though it's an independent body. The chairperson is nominated by the president. There are certain terms of independence. So when we talk about regulators, it's not only about efficiency and dynamic efficiency we should talk about. We should also talk about other values in terms of equity, justice, ideology, politics, because currently the vice president is getting involved in AI. I don't know how effective it's going to be, but they're trying to regulate AI and see where it's going. And it's not only like the quantifiable efficiencies that we have to look into, but we also have to look into other non-quantifiable values. It's hard to look at them because it's probably hard to measure them and give them a typical model, economic model, but we have to look at them. That's a reality. So that's just a question how you do that.
That's a great point. I think an agency like the SEC, it's an independent agency, and all of our commissioners, we can only have 3 of one party and 2 of another, so they try to insulate the agency from the political winds, I think, as much as possible, and our mission does not change with the administration, so at base, we're there for investor protection, market integrity, capital formation, and so I've been there a while, and with the changing administrations, there are some changes on the edges where you feel that kind of coming up, but I think for the most part, in just pulling it back to crypto, I think what we've seen is, on the financial stability side, we're still at that point where we're monitoring, where we don't see any real threat to the traditional markets right now without increasing interconnectedness, and people are monitoring that interconnectedness, and there is a lot of work being done at the FSB level as well as within the US. There's an FSOC report that came out pursuant to the executive order. But from an investor protection and market integrity angle, we don't have to look very far to see that there's harm being done now. And that harm is apparent in a number of fraud cases that we've brought and a number of catastrophic events that have happened over the last year. And so, I think the SEC mobilizes to address what it sees as significant harm and risk in market integrity and investor protection. And these things do play into kind of more systemic risks and then eventually into financial stability risks. And as does industries that that may be acting kind of in noncompliance with these laws that exist to cover the conduct that they're engaging in. And so, I don't know if I've answered your question, but
I'm talking about like the new, it might not be related to the crypto, but like the new ESG rule that's been going out. It has some political implications, like people are, some there's a backlash from one side and there's support for it on the side. So even when we talk about regulation, it's not only like in terms of economic efficiency, it's going to promote this efficiency, but there are also other values involved in it. Sustainability. You probably cannot really quantify it in terms of money right now, maybe in the future. But we have to keep in mind that those things are also there too. That's
Sure, and I won't comment about the climate rule, but I do take your point, that, and I challenge you to say, like, what issue exists that hasn't become kind of unfortunately polarized, and hopefully we can keep our eye on what is important from the SEC's perspective, which is, do investors want disclosure about ESG when they're deciding about things that they want to invest in and where they want to put their money, and we're gathering information through our rulemaking process, and that's all I can say on that. Thank you.
I understand.
Yeah.
Andreas, you're
There are
next.
a lot of questions. Andreas, okay, and then.
It sounds all very well intended, and we want to protect investors and generally people in the ecosystem of financial markets, but the devil is in the detail. And securities law, for instance, is extremely broad, and essentially it can apply to almost anything. Very broadly speaking. And so for instance, recently you ruled in a case against Bittrex that Algo and its token, or the Algo and its token Algo, is a security, an unregistered security. So there's two things that I'm worried about. So number one is there's real questions of compliance. So it's not just a question of you go and register, but then once you've registered, you have to do things, right? So in a world where people hold their assets in self-custody, that's a huge ask, because you don't know who your investors are. If you treat them as investors, how you can reach them with information. And so I'm not sure if you have a mechanism set up to deal with this kind of reality, because if you have trading platforms and brokerages where people keep their assets, it's easy, just go to the brokerages. But if you and we could exchange an asset, well, in principle, I would have to give you a prospectus anytime. So how can I comply with this, even as an individual? So that's the first thing that I have. And then the second thing is, like, if you think of an item like an Algo token, it has, if you rule that it is an investment, that puts all the compliance requirements on it. And that makes it not as usable anymore, because I have to give everybody a prospectus every time I transfer it. So that kind of destroys the intention of the token, which is to be a cryptocurrency in the network. It's intrinsic, it's built in, you can't run the network without it. So is there not a trade-off to consider between the usability, the intended use, and then what people make of it, which is the investment purpose? And so I'm trying to wonder if there's actually even a discussion around this, because at the moment it seems like if it could be potentially perceived as an investment, then it's a security and we're going to take out the sledgehammer. So, is there not a sense of harm that can be done for the basic functionality that is just unchangeable?
I can't talk about any particular asset. I'm just not permitted to do that. But I take your point. I think, when we're looking at the law as it exists today, we're regulators, so we apply that law as it exists. And the law that exists today is this broad-based view of what a security is. And if looking at the economics behind a transaction, if people are raising money to fund a project and the people who are giving that money expect some kind of return, that's a security. And so in 1933, Congress passed a law that said investors in a security are entitled to all these disclosures, full and fair disclosure. If it's a private sale between two people, that could fall into an exemption. We're talking about publicly offered securities that do not qualify for exemptions. And I don't think there's anything incompatible with, people have come in and they've registered issuances of tokens under the 33 Act, and it's a lot less complicated in my mind than the technology itself. Can you describe it in a disclosure statement? That's not rocket science. So I think, people have figured that out. They just, I take it, it's costlier, but, it's definitely something that has been done and people know how to do it. So
doesn't that cost crowd out a lot of the people that this technology could actually help and enable? Like, just as an example, an up-and-coming musician wants to issue an NFT to their fans that includes the royalty on their future earnings, and then they can use that money to go record an album, right? So the SEC would say, well, that's a security. And sure, come in, register, whatever. That costs a lot of money, which most up-and-coming artists don't have. So in that situation, who do we really protect?
Well, you're protecting the people who are investing and they're giving their money to that individual. What if that individual turns out to be a fraudster?
Well, fraud is already illegal though, right? Like fraud is illegal. You can go then, they can sue them, or a prosecutor could go and say, you promised something and you didn't deliver, that's fraud, it's illegal. That doesn't have anything to do with the registration with the SEC under securities laws.
But they could not be getting information that's fundamental about the company itself, the person behind it, about what are the financial plans of the individual, what are they going to do with the money, what can they do with the money.
I understand that, but you've literally made it impossible for an entire group of people who do not have access to easy fundraising in the old system to also not have access in the new system. And I think it's worth considering, who do we protect by doing that? Because what if the potential investors say, I'm okay, I'm going to take that risk because I like this guy's songs and I want to help him?
I'm not commenting about your hypothetical, but the fact that you've set it up as an old system and a new system, I think the way the SEC has viewed the law is that just because you're issuing and transferring something on a blockchain, if it's a security, it doesn't change the fundamental characteristics of that instrument, and the law applies to it. And as a regulator, we need to enforce that law. So if there's an argument that the law has changed, then that has to go to Congress.
Can I comment on that
Your,
as well?
your agency has made it clear, your chairman, that we do not need new laws. So I respect that you're speaking your own mind, but I do think it's worth considering, like you're citing the 33 Act and the 40 Act. The Howey test is from 1946. The transistor was not invented until 1947. So at a certain point, it becomes an exercise in ridiculousness to be like, the algo token should get the same exact treatment as the oranges in the orange grove that was the subject of the Howey test.
But when you're raising money from the public to fund a project, do you think that's different when you issue them a token as when you issue them a piece of paper or an uncertificated security? I mean, the nature of the transaction is the same. And
No, I think
that's what's governed under the securities laws.
Well, if we want to just regulate the act and say they need to give a statement, that's one thing. But the current interpretation is that the token itself becomes the security, right? So this NFT in this case would be a security, would it not be?
I don't know what your hypothetical is, honestly.
Sorry, I'm taking up too much of the time.
Michael wanted to add something, right?
But as economists, we always think in trade-offs, right? So you do one thing with, we understand there's a law, but we also understand that you don't have to enforce every law. There's a question of do no harm. And I think the point that you're trying to make is, you put a law on, yes, by the text of the law, you can have exactly that perspective, but there's a question, does it serve a purpose, and does the implementation of this not cause more harm because it prevents economic activity? And at the end of the day, the reason why you're there is to make sure that the markets can flourish. That's really what the SEC is about. It's not, you need a market as an issuer, you need to find a market. That's why you have actually the investor protection, because investors can't trust what comes their way, then there will be the issuers can't find a market. But in some sense, at some point, you go into the point where you're just destroying a market. That's the argument that we're having, and this is actually what we're actually all working on. We're trying to ask questions such as, what is the benefit of these assets? Do they serve a bigger purpose? Can we do something else that we can't do before? And we're kind of missing that discussion, and that coming out of your chairman in particular, right? To see the positives. Sorry.
You wanted to add something, Michael?
Well, I just wanted to give an analogy that might be useful. So suppose that in my backyard, I develop a nuclear power plant. And it's incredible because now I'm off grid. And now I can share this technology with others who do not want to rely on the power grid. And so now I've created it. And then a regulator comes and says, you've just built a nuclear power plant. Now you have to abide by all the regulations. And I say, well, I've already created it. We have to now do a cost-benefit analysis because all the safety regulations for those large power plants aren't really adjusted for mine. I think that's the question that I think you're posing. And the question I think is the answer I think is exactly what you just mentioned. Part of what we need to understand is what is the fundamental innovation that is there and what is the middle ground between those two things and what is the type of regulation that's needed. I don't think that it changes the fact that I still have a nuclear power plant with all the costs and benefits that a traditional type of power plant might have, but there are other features that we need to take into account. Now, you could say that imposing the same regulations on this small power plant would be so costly that no one can have backyard power plants anymore, and we're going to stunt innovation. But I think that's also kind of a very extremist view in terms of how we should approach this problem. And so, first, by tackling and understanding what the primitive features are that is really innovative and trying to better understand how regulation can be adapted for that, I think that's one of the questions that I posed today as well. If it's really about regulatory arbitrage, then that's not a good reason for us to not impose the same types of practices in terms of safety and regulation.
I think the discussion was, your position was this is the law. That's not what he said. And then the question is how much flexibility, how much leeway you have in interpreting the law. And then, with all due respect to the law, does the law make sense? Even if you don't have flexibility, it makes sense to apply in certain context. If not, maybe it's time to change the law. That's what the discussion was about.
May I make a comment?
Let's go. Let's use the first in, first out. Let's say. Let's use
I'll keep the topic on track. So I thought it was a great insight at the keynote over lunch, which was that kind of the big impact that we see in the real world from blockchain technology is just shining a light on how antiquated traditional financial intermediation is right now. And you could easily argue that regulations are sort of part of this problem where they create barriers to entry, they create monopoly power, they destroy the incentives for large intermediaries to innovate and create products that would ultimately benefit the consumers you're protecting with the regulations. So I think we're all asking the same question, which is there some systematic approach that you take towards sort of viewing this trade-off of if we regulate more, we create more barriers to entry, we create less competition. We know that low competition creates inefficiencies, and now you're
so financial stability is also an issue.
Right.
So if I lower regulation, I lower barriers to entry. There's more competition, but so I need to understand what's going to happen in the backyard with all the interconnections or the new innovations, because those might have an effect, might have externalities. Because I might be very happy to have freer entry into one market, but I'm not going to be happy if that generates externalities. And a lot of people are also not going to be happy, not just me, because I'm sitting at the Federal Reserve. So these are the kind of problems that we need to understand. And we cannot just get fixated on the entry costs. That's one dimension. There are a lot of dimensions. And sorry, we live in a dynamic world. So I don't want to go back to the example. But it's not just the regulators, it's also the response to the regulators. How about crowdfunding? So my cousin back in Italy raised money. I gave him money to open a pub. Now, he may have done that for a bunch of his friends. When you go in, you get a free sandwich. Now, if you don't give me the free burger or the free beer, what the heck? I'm not going to give you crowdfunding. So what I'm trying to say is that I do understand that the liquidity that comes from possibly issuing tokens is different from the fact that that's my cousin, or that's my friend, or that's my volleyball mate, and I'm gonna give them money. But what I'm trying to say is that society is resourceful in other ways, and it's coming up. For example, one way could be crowdfund what you need to get the license. So why not doing that? You raise the money instead to open the pub, to get the license, and then you do tokens. And you have all the liquidity benefits that you want from those liquid tokenized assets, tokenized whatever, claims on burgers or beers or songs. So yeah, it was just like to offer also another perspective. It's not just, oh, they're putting a law here, I cannot go faster than 50 miles per hour in a car. Maybe you can take a plane, helicopter, I don't know. You can bike a little bit.
Quentin, and then...
I have a question for Francesca as well. Actually, and I'll also be interested in Mo's opinion from the north of the border as well. So, but on your second point, on financial stability risk, you mentioned that having a stable coin that's basically a narrow bank because connected to the RP facility would create some additional bank run. I'm not sure I really see that because we already have money market funds that are themselves connected to the reverse repo facility. So I don't see how having a stablecoin also giving that option to the retail customers would add any bank run in the first place.
Yeah, flight to safety.
You know, I see that, but I'm just saying that we already have that now. So
you have another one.
Actually, I think probably as part of what we've seen with SVP, we've seen a lot of companies now moving to money market funds, and especially government-only money market funds. So it feels like that's a little bit remote. And also, I get a feeling that there's a little bit of inconsistency in terms of regulation between what we've been asking the money funds to do, to acting more and more as narrow banks, and then what we require, what we'd like to require from the stablecoins. Well, I'm asking that question because there has been a precedent where some initiatives for the creation of a bank, narrow bank, was actually declined. So it feels like I'm a little bit worried that this kind of argument would prevent Circle from accessing the reverse repo facility, and I think this would be potentially inconsistent with what we do, the way we regulate the money market funds in the first place.
So let me see if I understood the point. So I'll respond to something which is not the question I heard. Pose the question again, please. But so the way in which we have thought about CBDC, and we could see similarly Circle Reserve Fund at BlackRock and the ONRP, is that it is an asset that can be attracting funds fast in times of stress. And in that sense, I was assimilating it to CBDC because that is one of the concerns that we have studied, what we're looking at for CBDC if we were to issue, what's going to happen. And it's just in that sense. Now, when it comes to narrow banks, I think you were talking about TNB, the narrow bank.
Yes.
Yeah.
Yes.
And again, personally, I've got nothing against that. But banking theory is pretty clear that, I mean, I guess the Nobel Prize winners of this year made it pretty clear that narrow banking doesn't really serve social purpose. So what are you really doing? It's not a bank. The purpose of a bank is, at least in the way that we have seen it academically, can be different ones. You can see it as an insurance company, a la Diamond Dybvig, Nobel Prize winners. You can see it as a delegated monitoring, also Nobel Prize winners. You can see it in those ways. The narrow bank is not there. The narrow bank is basically the way that I have seen TNB. It has been basically regulatory passing on interest payments to others when we started paying interest on reserves, basically. And that, I think, is what would happen with market funds having access to NRP and then tokenizing. Yeah. And, but that per se, you know, you're creating some, again, regulatory arbitrage, or yeah, like passing on income. I personally don't have any problem with that, but the narrow bank or this model, apart from passing on a an arbitrage activity, has no economic purpose. It's not a bank with some purpose in the economy, the way I see it.
Okay, we've got 4 minutes left, so we're going to do 2 quick fire questions. So, Augustine, you choose the last 2.
Okay, yeah,
Pressure's on.
She has been asking for a long time, so I've seen your hand raised. Go ahead.
So my question is going a bit in a different direction. I tend to be very pro-regulation and financial stability. I have a lot of financial stability concerns. I was wondering how you're thinking about regulation of information when it comes to DeFi, because at least traditionally we often think that from a financial stability perspective, we don't always want there to be more information. So for like stress tests, maybe we prefer partial disclosure, or we're concerned about panic-based runs. And that seems like fundamentally like it goes against some of the tenets of the technology in DeFi. It's a little different from having a capital requirement or talking about deposit insurance. So I was thinking about how you're thinking about that aspect, like actually regulating information is a part of a fundamental part of the technology.
So I'll quickly say something, but anybody jump in. So what I think is that exactly those trade-offs are on our mind. And so in the example that I brought up earlier about the banks putting themselves together and not releasing any information about or balance sheet about any individual bank, but only the balance sheet of the clearinghouse, that is one example. That was exactly what stopped bank runs and banking panics in the past. And so that's how I personally think, yes, we should think about that trade-off and when is opacity or disclosure good. But that is a problem that, so Governor Walder has a paper on disclosure versus opacity. So it's a problem that is rooted in economics in many dimensions, and I think you're absolutely right that it comes up in this problem as well, in this issue as well. We're thinking this in the way that you're suggesting.
Yeah, and just to add on that, like data gaps is a big concern around monitoring the risk here, because I mean, obviously in CeFi there's data gaps because a lot of things happen off chain and there's a lot of interconnectedness that no one knows about until something like FTX goes wrong. But then if you look at DeFi, a lot of stuff is on chain. There's a lot of stuff that happens off chain as well, and there's also interconnectedness. And a lot of the data that's coming, at least through other third-party platforms, is not audited or verified in any way. So when I'm trying to monitor risk, and you know the banking industry is trying to monitor risk, these data gaps are a problem. So to the extent you guys are doing research, I mean that's the kind of thing that would be really helpful for us.
All right, Augustine, who's the lucky last?
Yeah, like last question, and then closing remark. You pick.
Thank you. This is for Valerie. So Since 1990, there are tremendous changes in the trading systems, marked mostly by the decline of the floor markets. And over that process, I thought the SEC did a pretty good job of incrementally regulating the pace of change. One of the tools that they used, I believe, were no action letters that sort of judiciously allowed enough slippage in the system to get some innovation without upsetting the whole apple cart. When do you think those are appropriate?
Great question, and I think that goes into one of the tools that the SEC has to promote innovation. And so we have given no action letters in the digital asset space. We've given at least 3 on the 33 Act side for digital assets that were issued in a way that we became comfortable we're not going to implicate the federal securities laws, essentially. So we gave three projects no action letters, and then on the trading and market side, there was a no action letter to Taxos for engaging in delivery versus payment system without having to register as a clearing agency. Again, these are firms that are coming in and working with staff to give comfort to the staff that they're not going to do things in a way that is going to create a risk of harm. So that might be an appropriate circumstance. And then there's a commission level no action statement that relates to how broker-dealers can custody digital asset securities without raising concerns under the customer protection rule provision. So those are out there.
Thank you.
Well, guys, this was a very engaging panel. But a couple of closing remarks on this. I just want to say that when it comes to the skin in the game, these guys are all public servants, so everyone actually here has skin in the game in this regard. And these officers take their job seriously. Last night we were supposed to have a dinner with the speakers to gather up, and quite frankly, none of them are allowed to do it because that will be against can't take any gifts of any sort. So this is how serious that these guys take their job. They've got a tough job, as you probably discovered today, of just trying to find where that balance is, and to be able to get that balance, you need your help. Going back to my original example, we catch a plane, we go into buildings, we do all sorts of things because the regulations are there to help this economic growth. And what we need to do, when you guys are looking at all your technologies, to assess those risks for financial stability, customer harm. If you can get past those guys, if you can get past those with the nod from these guys, good luck with your technology. Thank you very much, guys.